hopefully 10 to 15 minutes after that to go ahead and answer your questions. You have a ability to download in that dashboard too a copy of this PowerPoint presentation. I'd encourage you to do that. This is a you're gonna get a lot of great material out of this. Jacob has actually given this presentation on probably 2 or 3 different occasions to broker-dealers throughout the country in the last 6 months, and so he's really perfected this quite well. A couple of things that I'd like to say about ongoing reviews, and it's really a challenge to everybody that's on the call. First, if you're getting ongoing review for a quarter, and the next quarter has already passed, and so there's a new set of filings, and you're only getting a report on the old filings just now. For instance, you're getting a second quarter report in the fourth quarter. I would say that material is very close to irrelevant. And so the first order of business, of course, is to make sure that you get timely diligence, quarterly diligence reports, because you only do diligence because you're assessing suitability. And at the time you get a report, if it's irrelevant because a new quarter has come and gone, I'd suggest you're behind in terms of your filings. Second, another challenge, examine the quarterly reports you're receiving from your providers, all of them, and let's make sure we're not getting a lot of cut and pasting from SEC filings. That does no one any good. So the analysis that's done and the analysis that Jacob's going to run through, in our opinion, is critical to understanding the direction of a product, not just a snapshot of the product, but the direction in which it's heading. So we think that's important. So without further ado, Jacob, I'll turn it over to you for the presentation.
Sounds good. Thanks, Scott, and thanks everyone for attending today's webinar on mitigating risk with ongoing reviews. This is a key component of maintaining the best alternative investments platform that you can. With ongoing due diligence, we're able to mitigate risks before they become headlines. Even more, the techniques that we're going to discuss today, you can use them to proactively identify investment opportunities in the alternative space. Ongoing due diligence is really what separates a good investment platform from a great investment platform. So today I'm going to start by going over the regulatory requirements. I'm going to discuss what FINRA says you need to do at the home office, in addition to what responsibilities that registered reps have. And I'll also discuss a little bit on how this will change, or the standards will increase as we move towards the fiduciary standard. And although these regulatory requirements can be challenging, we'll also see how keeping up to date on these programs makes solid business sense. In this webinar, I'm also going to reveal some of the secret sauce that goes into FactRight's ongoing due diligence efforts. I'll show some tips and techniques that we use to get key information from public regulatory filings. Additionally, I'll highlight red flags that frequently come up with REITs and BDCs and closed-end funds. And these are the type of things that can be missed if you just rely on the top-level data. Now, I know a lot of work goes into deciding whether or not to sign a selling agreement. But when you sign a selling agreement, that really marks the beginning and not the end. Alternative investment funds, such as REITs, BDCs, and other funds, they evolve over time. They're often starting out as blind pools, and they'll begin investing in assets under changing market conditions. And a key step that needs to be done over and over is reviewing them each quarter to make sure that nothing major has changed and that management is implementing their strategy as they said they would. There's a wide variety of specific regulations that show the need for ongoing due diligence. FINRA 2111 discusses suitability. 1125 and 1225 each have some Q&A that discuss this, and they also make clear that the reps selling products need to have knowledge of products, both how they work and how they've changed over time. FINRA is very clear that complex products require heightened due diligence. And since the products can change dramatically over a few quarters, it's critical to review them regularly and, of course, document the review consistently. So this discussion encompasses a wide variety of public non-traded programs, especially REITs and BDCs, but also some other types of funds as well. Different strategies work under different market conditions, so it's critical to be aware how if the strategy is working or not in the current environment. Keep in mind that as the marketplace moves towards fiduciary standard for broker-dealers, the importance of ongoing work is going to increase. The importance of making sure that programs in your platform are performing as planned will become even more important. And we're going to send some follow-up materials on this very issue. Some guidance from regulators and from courts indicates that a fiduciary has a responsibility to monitor fees, performance, continuity of management, and changes in market conditions and how they're impacting a strategy. So look for some follow-up materials on these very topics in the coming weeks. And it's these areas that really form the basis for the approach that we take with our ongoing due diligence. Even as we dive into the filings and into the footnotes, we never lose sight of a key set of questions. What are the trends? How is the company making or losing money? How is the advisor and sponsor being paid? And has the structure of the compensation been changed since the initial selling agreement was signed? Is the advisor keeping up with the original strategy? This is critical from a portfolio manager standpoint because sometimes funds will end up doing something radically different than what they originally planned. Another thing to consider too is the sustainability of distributions. Everybody wants income, but if you over-distribute, you end up eroding the net asset value and it results in unpleasant surprises down the road. Additionally, it's important to monitor if a fund is in compliance with structural requirements. This include leverage limitations as well as investment restrictions. For example, BDCs have limitations on the amount of leverage they can use, and also they have to invest a certain percentage of their assets in smaller U.S. companies. We also look at the balance sheet and the related trends to verify that a company is both solvent and liquid. And closely related is a set of red flag checks that we do. Just to, there's a few areas where you can quickly check to make sure that there isn't a major insolvency or legal issue on the horizon. Now, information overload is a common complaint that I hear from a lot of broker-dealers. And there's just too much information, just piles and piles of reports. And if you think it's getting worse, you're actually right. There's plenty of data to back this up. The average length of a 10K has increased more than 3.5-fold since the 1990s. Personally, I think I blame the lawyers, but there's a lot of issues that go into that. And perspectives of the course are even worse. So dealing with this challenge requires using the right technological tools and focusing on the key sections of the filings that are most likely to have the most important information. So although the size of 10Ks and 10Qs can sometimes be overwhelming, they are on a form. It's a very long form, but it's a form nonetheless. And they have a consistent format that they follow. The same information is going to be in the same spot every time. Key sections discussing the fund's strategy and performance include the business section, along with the financial statements and management discussion and analysis. Some of the other key sections we have on here are where red flags are often buried. In a rising interest rate environment or volatile capital markets, the market risk disclosure has been increased in performance. The risk factors are mostly boilerplate, but they need to be checked for changes. And there's also a section called Other Information that includes things that have occurred since the most recent quarter, which may not have been announced in a press release. So this information is available in both 10Qs and 10Ks, slightly different spot, but it's something that can be consistently pulled out each time. So now on to the business section of a 10K. The business section is where you go to understand the fund strategy and investment process. If it's gone through a restructuring, it'll be described in this part. Additionally, This section can help the analyst understand the regulatory issues that a fund is subject to. For example, if they're a BDC, it'll discuss the regulations they have to comply with to stay as a BDC. If they're a REIT, it'll discuss that. If they're investing in, say, medical office properties, it'll discuss how Medicare and other things can affect their tenants. Now, financial statements are the key sources of information. These include the balance sheet, the cash flow statement, the income statement, and the statement of changes in equity. The 10Qs are unaudited, but the annual report on Form 10K does go through a full audit for all the public programs. And these numbers, they have real meaning. The job of an analyst is to understand the why behind the numbers and to understand the trends. And in the ongoing coverage that we provide summaries of key information. And we put a lot of resources in to pull out key information from financial statements so that we can spend time analyzing the data rather than looking for the data. Now, when there's a lot of money on the line, the details matter. So if you want to avoid nasty surprises, important disclosures are often buried in the footnotes. The key items that are almost always in the footnotes include distribution coverage, detailed portfolio data, related party transactions, valuation methods used, and financing arrangements or the line of credit issues. I'm going to go deep on a couple of these because they're important and they've had some big impact on a lot of programs in this space. First off is distribution coverage. Everybody wants income, but burning the furniture to keep warm is not a sustainable strategy. So it's important to understand how are they able to pay distributions. Is it from cash flow? Is it cash flow from operations? Is it from the capital raise? Are they borrowing money? Are they selling assets? So analysts can check this information against cash flow statements as well. And the management discussion and analysis section we're going to discuss later can also have information. But this is an important part of due diligence, is understanding if distributions are sustainable, because it's a key reason why a lot of people invest in alternative investments. The quarterly filings are delayed by almost 2 months, and 10K is a little bit longer. So information that comes out after the balance sheet date, but before the report is actually filed with the SEC, is in a section called is going to be in a section called subsequent events in the footnotes. This is especially important to review when a fund is in acquisition mode. Sometimes they may have had 1 or 2 properties at the balance sheet date, but then they acquired, say, 5 or 10 after the fact, and that's going to affect your analysis of the fund. Sometimes too, a REIT or BDC will really pick up capital raising momentum after a quarter, and then that information will be in the subsequent events. And what you often see here is sort of the balance between the need to deploy capital so that you can pay distributions, and you don't want to pay someone a management fee to sit on cash, but at the same time, you want them to avoid being overstretched. So this is just an example from a fund which will not be named, but it's just an example of a fund that acquired a lot of properties after the 10Q date, and it ultimately impacted our analysis of the portfolio and if the fund was being successful so far. For BDCs in particular, there's going to be a valuable footnote disclosing important portfolio information. Often in the balance sheet, it's basically just like one number, and schedule of investments doesn't really disaggregate things, but there'll be a footnote disclosing like how much they have in different types of assets, what the average yield is. It varies from fund to fund, but the key information that helps you understand the strategy of BDC is going to be in a footnote on their investments. with REITs, you often get similar info on recent or pending acquisitions, and really the only spot they disclose it is in the footnote. Unfortunately, for each program, the footnote number is usually pretty consistent between quarters. So if it's like footnote 5 for a fund, it'll always be that same footnote, so it allows you to compare from quarter to quarter. Now, there's a section of every 10K and 10Q called Management Discussion and Analysis. This is an extremely valuable narrative that explains the changes in the fund that have occurred over time. Essentially, this is management describing what they think the why behind the numbers is. If I'm familiar with the program in general and I'm just getting an update on it, this will actually be the first section that I go to in a 10Q or a 10K. Examples of things you find here are changes in liquidity, business trends, uncertainties, changes in accounting methods, off-balance sheet arrangements. Basically, any information that is necessary to understand the financial condition of the company, it has to be put here legally. Like they have to disclose it in some regard. Also for REITs, if they disclose funds from operations, it's usually going to be in this section. And you can also see how they calculate it. I mean, you can understand like why and how they're able to meet the numbers that they have. And of course, it's great to also have an actual discussion with management, but this provides sort of a good discussion point. And the thing is, like in this section, they're under very, very strict legal requirements. So you're not going to get the sales pitch. Just a quick note, this is in both annually and quarterly reports, although it's in slightly different sections. And you can reference this later if you need to find it for a specific program. Again, for BDCs in particular, their management discussion and analysis is going to have a subsection breaking down portfolio asset quality. BDCs, because of 40 Act, they're all going to have a internal rating system for monitoring program loans. And of course, management has discretion on how they rate things, but this can be checked against net interest income and financial statements. And this is pretty important as an early warning system for when asset quality is deteriorating. Because usually, with leveraged loans, it's not just suddenly that it goes on non-accrual. Usually, the management will notice that the portfolio company's business is deteriorating, and they'll disclose it here. But then at the same time, too, as conditions improve, it often goes in another direction. So like last year, late last year, we saw a lot of BDCs disclose problem loans in this section, and then later they, in many cases, they noted improved conditions for their companies. Yesterday, we got another reminder that, yes, interest rates can go up. We've been in a very steady low interest rate environment for a long time. Potentially, that may change in the future. The key thing is you want to know how the funds you invest in are going to react in a rising interest rate environment, or if there's capital market volatility. Companies are required to disclose some commentary and estimate on how they will be impacted by changes in interest rates and volatile capital markets. It's usually just an estimate based on a snapshot of the portfolio at a given time, but it can be revealing, and it's worth a quick check. And it's quite revealing in just terms of their strategy and how management views their strategy. And it's going to be disclosed in every 10Q and 10K. 10Qs and 10Ks also have a section called Other Information. Usually, this is blank, but it can also be used to include information that would normally be disclosed in an 8K and a press release. And shoving information here is one way that a fund can bury problems and still be in compliance with regulations. So it's worth a quick check just from a due diligence standpoint. And often there's less attention on these items than 8Ks, but it can be equally important. $10Ks also contain a section called risk factors. These are usually just generic boilerplate, but impending problems such as liquidity or solvency issues can also be buried here. And if a new risk factor is added in a 10Q, it means that that is an actual new material and specific issue. What an analyst can do is run a quick red line between different filings to see if there were major new specific items that were hidden in there. It's a quick check that allows you to sleep better at night, basically. Similar logic also applies to other areas of the boilerplate too. The most efficient way to separate out new material and specific information that a company may want to hide is to run a quick red line comparing the two documents. Material language changes are not an accident. And there's a reason. If a lawyer put in there, it's for a good reason. They want to be able to essentially say that that investors were forewarned. Now, in investing, it's important to get bad news early and to avoid being surprised by headlines. There are a few basic checks that can be done on regulatory filings to identify red flags. Some of these include the risk factors that we just discussed. Additionally, there's also a section of every filing called legal proceedings. In most cases, that's going to be blank, or it'll just say there's no legal proceedings. But by checking that section quickly, you can see if there's something on the horizon, basically. Other things to note too are major changes to agreements with external management. Like if a manager wants to raise fees and extend a contract to 20 years, it'll often be kind of shoved in a 10Q. Other things to watch for, and these are very serious if they come up, are qualified audit opinions or internal control issues, or going concern warnings as well. Those rarely come up, but when they do, you want to know as soon as possible. And where it's going to be disclosed is going to be in the 10Q and the 10K. So wrapping up, here's a list of online sources related to regulatory filings needed to conduct due diligence. You're welcome to follow up with those. And we'll be sending you follow-up materials as well. All right. Thank you, everyone, for your time today. For more information and to access reports, you can visit FactRightReports.com, and you make that your homepage. And just if you want to discuss the full suite of services, feel free to reach out to Scott Smith or myself. And with that, let's see if we can open up to other questions.
All right, very good. Thank you, Jacob. A couple of questions came in, and let me address a couple of those. Let me read through this. Yes. One question regarding the way in which you can receive reports, quarterly supplements, and I'm going to touch upon two potential reasons for this question. First, in all of our engagements with non-traded product sponsors, registered product sponsors, every one of the initial engagements now has an automatic quarterly supplement engagement as well. So we're covering everything that goes forward that we are initially assigned to review. If you're not part of our report center, then I highly encourage you to go out to FactRight.com, log into our report center. From there, you will receive every supplement via email once we produce that supplement. So once it's published, you get an automatic report and an email sent to you to your inbox. We are in the process of making changes to that report center, which we're very excited about, to create a more dynamic interaction between you, our clients, the broker-dealers, and FactRight, which will enhance the ability for you to tell us and consequently tell the sponsors that you're seeking our coverage for a particular product that might be on your platform. So I want to just highlight that in terms of what's coming down the pike for 2017. It's part of our plans, and we're going to tackle those starting in January. I'm really excited to announce those changes to our technology going forward. And then I have one more item to talk about with that, but I'll do that later. I do want to talk about how will this change for interval funds or private placements. Jacob, could you comment on that?
One key difference with the interval funds in particular is that although they're public programs, the quarterly reporting they do is a bit different. So it'll be on Form NQ instead of 10Q. And interval funds don't publish the same level of detailed information every quarter. They do it twice per year, where they'll put the financial statements. And in the interim quarters, you just get a portfolio snapshot. So with interval funds, you can still monitor the portfolio and how it changes over a quarterly basis, but in terms of for the detailed analysis that the detailed analysis of the financial statements, that's going to be done on a twice per year basis instead. In terms of private placements, those can vary widely by sponsor because the reporting requirements are less clear, and they vary. They depend on the operating agreements and the PPM the fund is under. We definitely believe that it's something that you need to do additional monitoring. All of it is just that you're going to be less consistent in the information that you get with private placements.
Yeah, I'd agree that it's much harder to compare and contrast across one private placement to another versus one non-trader REIT to another non-trader REIT or BDC to BDC. Certainly, the driver of more coverage ongoing with private placements is your firm and you who are on the call. So as we have discussed this internally, the need for some level of ongoing services regarding private placements, the scope, depth, and cost are all things that need to be continuously considered, and we will be reaching out to you next year at some level to talk about what you would require, and that by extension what we would have to go back to the sponsors and push for. So I think that's definitely a very timely question as more private placements are getting sold. One question also was, how do we get older FactRight reports? Just contact, you can go to our website and there's a web submission form for a request. Go ahead and go to our website, fill out that web submission form, and we'll respond to you. We can provide you with older reports that are not on the report center. This webinar, another question, is available in print form, and it is available in the handout section on your dashboard. So you'll see a PDF on the dashboard under handouts. You'll be able to download this material from that section. Question is, if a rep comes to our BD with an offering we never sold before, it'd be nice to review the FR report even if it is closed. That, again, I think that relates to the section, the question I just answered. So What are you doing about a particular question about Payson Petroleum? Payson was a private product, and as such, we are no longer under any engagement to review that oil and gas limited partnership. If there's requests from broker-dealers to do that, we can go back to them and request further reviews, but as of right now, we have no insight, nor do we have any access into getting any information on a particular program that's closed, particularly if it's a private placement. So that's going to wrap it up. One thing I want to leave you with, and certainly reach out to us. If you want Jacob's particular advice on your platform, or you would like access to Jacob, we provide that. Jacob provides that through our risk management division. Jacob's a senior analyst through our risk management division. We work with 25 clients, and on a quarterly basis, certainly on the initial look, but on a quarterly basis, we provide services very similar to how Jacob had just rolled out these services, but very tailored to your platform and the programs that you are reviewing and have to review on an ongoing basis. Also, reach out to me, Scott@FactRight.com. We're launching a new beta product in the first quarter of next year in risk management around ongoing diligence. It involves your advisors. We'd love to get your feedback. We'd love to get your advisors' feedback. We think that under an increased regulatory scrutiny, especially under a fiduciary standard, there's going to be more need for more information amongst both the home office and the advisor community. And we think particularly through some of the technology that we're about to enhance, we think we're going to be uniquely positioned to be able to do that on a scalable basis going forward in 2017. So again, Scott@FactRight.com, Jacob@FactRight.com. Reach out to either of us. We'd love to connect with you. That'll conclude today's webinar session. Again, thanks for your time. We will be following up with some materials. Jacob had alluded to that earlier. Have a great holiday season, and we look forward to connecting with you either before the holiday or hopefully shortly thereafter. Have a great day.